tonight we have a very special guest here at InvestCaps, a successful trader with long experience in the financial markets, and also an author of widely acclaimed book series called The Market Wizards. The very first in line, called Market Wizards, is also very popular here in Poland. But a couple of months ago, Jack Schwager wrote another one in the series called Unknown Market Wizards. And it's Jack Schwager here tonight at InvestCaps. How are you doing, Jack?
I'm great, thanks.
Jack, welcome to InvestCaps again, and great to have you here. Surely there are a lot of beginners, market beginners watching us right now, and they are wondering how to get started in the market. So people also like to hear stories, and Jack, I would like to hear, how did you start your career as a trader, and did you really dream to be a trader as a child?
No. In fact, I had no particular interest in markets at all. And I ended up being involved in markets pretty much by accident. I was out of graduate school looking for a job, with an economics degree, looking for a job. I was just looking for something analytical. And it so happened that the first job that I landed that was interesting was as an analyst in the futures markets. And once you're an analyst, in markets, then you become kind of, the next step is to want to trade yourself. So that's pretty much how I fell into it.
Mm-hmm. Jack, you are probably most famous for your book series called Market Wizards, rather than a trader. And as you definitely inspired a lot of people by bringing all these trader profiles and stories to them, did you really plan on becoming a writer, or was it some kind of a spontaneous decision also?
Yeah, it was pretty much, I think everything in my life that's important happened by accident, more or less. So I didn't plan to be a writer. What essentially happened, and by the way, I don't think of myself as a trader. I mean, I trade, but it's never been a full-time avocation. I don't consider myself a particularly good trader. The only reason I'm profitable is because I have the experience of doing all those books, but myself, I don't consider myself intuitively or instinctively geared to be a trader. It wasn't something I dreamed to do or ever did full time. As far as writing, I was like I said, I was an analyst, and I became a research director. And back when I got into the business, which was the early 70s or during the 70s, I didn't really think there was a good book on futures markets or analysis of futures markets. And I took a sabbatical in 1983 I thought I could do a better book than anybody else had done up to that point. So I took a sabbatical to write what I called the complete guide to the futures markets. And that's how I fell into writing. And that went well, and that ultimately led to an invitation to do more books, and that led to the Market Wizards series.
I wonder, does writing help to, become a better trader?
Well, the best way to learn something is to try to teach it to somebody else. And so I think by forcing you to think clearly about all these things, it was certainly helpful. And even you go back to that first book, Complete Guide to the Futures Markets, which was revised in 2017, you can find some. I mean, I hadn't done any of the Market Wizards books yet, but I think you'd find some of the thinking there, particularly as it goes to in regards to trading, compatible with some of the lessons that came out of the Market Wizards.
Mm-hmm. Jack, let's get a little bit more technical right now. You've been around since the 70s, since the 80s. So you have witnessed this big technological change in the markets during the 80s and 90s and 2000s especially. So what are some of the most striking differences that you have witnessed between the times that you have started and right now?
Sure. Really, you touched upon, or you really hit maybe the biggest difference, which is computerization in all its aspects. So back, in 1971, well, in every respect, I think back, we didn't have computer screens on our desks. I remember the first job I had was a big board that would, click and clack, when prices changed, and that's how brokers knew and analysts knew what the current market's prices were. There were no, this was way pre-PCs, let alone powerful PCs. So you're dealing, and what existed in computers at that time, sort of my first job right out of graduate school, but I remember my senior year of college, to do just basic analytics, you would use a mainframe computer, which would fill half a room. And so that was the world back then, way before PCs, big computers to do not that complicated tasks and so forth. And since then, of course, we've seen the advent, tremendous increase, exponential increase in computing power. Current desktop PCs are more powerful than mainframes, or by a large factor. And you now have in the hands of everybody this massive computing power, plus all the data. I mean, all this data wasn't available back then. And the combination of computing power and data has brought in a whole slew of quantitative people into the market. So you have hedge funds with 100 plus quants working for them, PhDs in math and astrophysics and so forth. So whereas back in the early 70s, if you're doing simple trend following, moving averages, that was high tech back then, So it's been a very dramatic change in terms of the quantitative power and the people who have the skill to use that quantitative power being involved in markets. That's the biggest change, and it's enormous. That's probably the biggest change in markets. Another major change, of course, is back when I started, futures markets, you had trading pits for quite a while. It was decades before we got electronic trading. Of course, now virtually all trading is electronic, and that's also a big difference.
Yeah, that's an interesting point. And there's also this big debate right now whether technical analysis still works as it did way back in the 70s or 80s. And one of your interviews in your recent book, that is Peter Brandt, have spoken not much so. Do you agree with that?
Well, Brandt has been, so Brandt is a good example. Brandt is my age, maybe he's a year older. But he came, so he's been around almost, he was in advertising first, so he's not been around in the markets as long as I have. I think he got involved in the markets closer to the late 70s. But he's been around for a long time. And he's used chart, and the way he became successful was by using charts and technical analysis. And he still does that, and he still uses a similar risk management approach. But he will also tell you that things have changed, and because chart analysis has become so popular, the number of things that used to work no longer work, or there's a more predilection. Maybe I think he would agree with me. There's much more. It's much more common now to get false breakouts as opposed to legitimate breakouts in markets and so forth. So it still works, but it's not. Let me paraphrase the way I think Brandt would say it, and I totally agree with this. It's not that the charts are predictive or there's a secret chart pattern that you find that's going to work. It's more a matter that you can use charts as a tool, and you can use them as a tool to identify points in time where you can take a trade and the potential return at that point in time is significantly greater than the risk you have to allow for that trade. So you get an asymmetric return risk profile at that particular point in time. But it's not that you can bet your life that chart pattern is going to work. Most times it won't work, but the point is that when it does work, you're going to make multiples of what you lose when you lose, and that's what makes chart analysis work. So it's not magic, it's not predictive, it's a tool. It's really a tool is the best way to describe it.
Yeah. And to be specific, what are some of the elements of technical analysis, like, for example, moving averages, patterns? Which of these do not work as they did back then?
I think when I wrote the book A Complete Guide to the Futures Markets, and this is back in '83, it came out in '84, the first edition. So even back then, I understood this, and I think it's even more true today. And that is, and this is very important to realize. I have a chapter. I think the title of it is something like "The Most Important Rule in Chart Analysis," and that rule essentially is that patterns that fail can be more predictive than the pattern itself. So if you've got let's say you got a market that's consolidating near highs and it breaks out to new highs, and then a few days later it comes back down into the range and starts moving down, that false breakout can be more predictive than the actual breakout itself. Although sometimes breakouts work and they go for a long run. The point is that you have to be flexible. You have to not only use the patterns as they're interpreted in traditional chart analysis books, but also be able to react and interpret what happens when those patterns fail. And maybe most important, it's not the patterns, it's the risk management that goes with it. So whatever approach you use, or whatever indicator, whatever chart pattern you use, as long as you have your risk defined and it's significantly less than the potential of the return, then you have a way of effectively using charts and technical analysis. But there's no magic indicator, there's no magic chart pattern, it's how you use it.
Let's leave technicals aside for a while. We will come back to them later. As I said before, I suppose there's a substantial number of people watching us right now who want to start their career as traders. And there's this question, could an average Joe doing trading part-time become really successful? Or do you think trading must be a full-time job with full emphasis on training all day?
No, it doesn't have to be a full-time job. That much I can tell you offhand for sure. There are plenty of good traders, successful traders that only check prices after the close at the end of the day. Well, I can give you a couple examples. Tom Basso, who was a CTA, retired to trade his own money about, I think, 17, 18 years ago. Michael Vell wrote a book about him, or with his interviews with him as well, which just came out. And in there, he kind of mentions that he'll go on vacation and he'll take his computer with him, and it'll take him 20 minutes, 30 minutes to update his programs, and that's all he needs. And so there are plenty of successful traders out there that just once a day is enough. Also, Brandt, basically his thing, while he'll check the markets every day, essentially his real work comes after the Friday close. So he's really busy Friday night, Saturday, and he basically plans out his whole week. And almost all the trades of any consequence that he takes are done on a week-by-week decision. The intra-week trades he does, he doesn't even know if they're net profitable, and are not an important part of his trading. So there somebody's only doing the work once a week. So I think that part of it is hopeful. You can work, you can have a full-time job and still do trading part-time. That's not to imply that trading is easy. It's just saying that that's possible to do. To get to that point, though, you have to develop a methodology that's effective, and you have to have the discipline to apply it, and you have to be rigorous in your risk management.
Yeah, trading isn't easy, and it requires skills. And skills are important, but another thing that is also important is capital. And in your opinion, what kind of capital is sufficient for beginners to have acceptable returns with manageable risk?
Yeah, that's a tough one. I suppose if you're trading stocks these days, you can start with a small amount of capital, because you could buy one share, or two shares. I mean, you can really trade small. If you're trading futures, and I guess even on FX, you could trade small amounts of money. So, again, you could be small. Futures, by definition, most contracts are large enough that it's unrealistic to have to think you can trade with 10,000, or less. You probably need considerably more, or else every trade is going to be too much of your capital. But one important lesson I would say for anybody, particularly if they're beginning, is whatever amount of capital you take to start an account, decide ahead of time how much you're willing to lose before you close all your positions and go back to the drawing board. So let's say you had, say you had $50,000 that you could open an account with. You don't want to risk the whole $50,000. You want to say to yourself, well, I've done my work, I've done analysis, I've done research, I've got a method, I've paper traded it, it seems to work, I have risk management, all of this stuff. You've done all the preparation. So you say, okay, so I think I can trade, I have a chance of being profitable, I've got a $50,000 account, I'll risk 25% of it, and if I lose 25%, I'll close the account, go back to research and try again. That way you assure, so then if you lose 12,500, you basically, if your account goes down to 37,500, that day you close all your remaining positions, you stop trading, you take a breather, you go back and do some more research, you wait until you're ready to try again, and then you try again. But doing it that way assures that you are able to come back and have a second chance, because most people are, including the people I interviewed in the Market Wizard books, most of them are not successful. In fact, many lose their entire account in the first try. So recognizing that, it's a good idea to limit your loss on that account so you have the capital to come back in. Whatever your capital is, whether it's 100 or 50,000 or 25, it's true for any amount. You want to limit the percentage you can lose before you stop trading. Otherwise, you can blow it all and you won't have a second chance.
Well, that was an interesting strategy, Jack. A lot of market wisdom is all about controlling emotions. Sometimes it's almost like traders need to become these kind of androids who are just numb to any kind of emotions. And do you think that a trader needs to be as emotionless as possible?
Yes, I do. I really, really do. I think emotions translate to our basic instincts, which are, part of evolution, right? So fear, fear that you feel in the markets. I mean, that's part of an evolutionary process, that if you see some animal moving in the leaves, that you might be a predator, you're ready to run or get ready or whatever. So that's kind of instinctively built in. And the things that were built in, evolutionary-wise, are not conducive to good trading. In fact, one of the traders I interviewed in the new Market Wizards book, Bill Eckhart, said that we've evolved as humans. Our human nature is so poorly attuned to trading that most people will do worse than random. And what he's literally saying is that it's not like the old cliche about the monkey throwing darts at the Wall Street page and doing as well as the professional money managers. He's saying that the monkey will do better because it's not inhibited by human emotions. We gravitate to, as he puts it, to seek comfort, and the market doesn't pay you for being comfortable. So all these things that relate to emotion are detrimental. There's a quote I use in one of my books from Alex Honnold, who's probably the world's most famous free climber, and people who don't know what that is, it's this crazy sport where you climb these sheer cliffs like Yosemite, 2,000 feet. Very few people can do this or should do it. Probably nobody should do it, but he does it. And they'll climb it without any ropes or protection. And of course, one mistake and you're dead. And he was being interviewed on 60 Minutes, which is a news magazine program in the U.S. And the correspondent asked him, "Do you ever feel an adrenaline rush?" And he kind of shocked. He says, "Oh, no." He said, if there's ever any adrenaline, then something is drastically wrong. Everything has to be slow and controlled. And that's when I heard that, I kind of just paused the button and replayed it and copied it down so I could use the quote, because it's so true of trading. People think that trading is all, and it comes from Hollywood. if you see any movie that has trading or TV show, it's always all this noise and bedlam and emotion and just complete turmoil. And that's because that makes good, cinema or TV. If you go to an actual trading room or an actual trader, it's, it's more like a library. So a good trader, is just going to be doing what they're doing. It's going to be quiet. He's not going to be emotional. I can think of one trader that I interviewed where I went in and I knew he was short the stock market and it had been going up and up and up. And the day I interviewed him, it had a big down and all the screens were red. I knew it was he had a really great day, but he was kind of totally even keel. You couldn't tell if he was up or down. I'm sure if I went in a day where he was losing money, it would have been the same thing. So really good traders have control of their emotions. They execute a process. They don't get emotion. Emotions will interfere with good trading.
Well, that's pretty extreme, to be honest. And I wonder how to be satisfied with your work as a trader when you need to force yourself to be numb to emotions almost all the time.
Well, the satisfaction doesn't come from, it's not a matter of jumping up and down when you win money and getting, I kind of think of let me tell you what it is, and I kind of think of a Kurt Vonnegut book. I think it was Sirens of Titan, and in there is this thing: these aliens kidnap a couple, and they put them in a display, like a zoo, and they tell them they've invested $1 million for them back on Earth, and they let the prices go up and down kind of randomly. And so they get emotional, and of course the aliens can watch them and be amused. And that's not what trading is about. It's not about getting really happy or sad, when it's going your way or not. It's about having a methodology and executing it efficiently, and not being driven by the emotion. It's executing properly.
Well, we will leave emotions aside for a while. And during your career as an author, you have interviewed an incredible number of different traders. But I was thinking, how many of them really ended their careers successfully with cash in their pockets?
Yeah, so a large percentage, I would say, but I can't give you any statistics because what I haven't done is, follow up on the traders, on the traders I interviewed. And, some of them are well known, so people like Druckenmiller, Kovner, Paul Tudor Jones, etc. They went on, had these big hedge funds, and they did well and all that. So people at high visibility, you kind of know, even if I don't go back and look at their numbers, I kind of know they did well. But a lot of people, a lot of traders I interviewed are just, are more low key or just on their own, and you don't necessarily, or you're tired, you really don't know what happened. And so I don't have the statistics to answer that. So I for the most part, I think they probably did just fine, but there are a couple, I can think of one or two, I won't go into it, but that I know that, that they then had tough times, but I don't know what the percentages break out.
Mm-hmm, mm-hmm. Earlier in the interview, you said that the market's changed in the last 40 years, and that change created a situation where traders needed to adapt to the changes in the markets. And what was the most crazy change that you have witnessed and seen during the interviews for the Market Wizards book?
Crazy changes, meaning?
I mean crazy changes of trading strategies of particular trader.
Oh, I see. Okay. Well, you have a couple of, I can take a couple examples from Monroe Market Wizards, the book I just did. So there's one trader in there that would trade market events like central bank announcements and stuff like that. He'd be very prepared. He still does that, but and initially it was a matter of He would be sitting there with his finger on a mouse and listening to the statement being made. He was very prepared. He knew what words to listen for. And as soon as he heard something, he put in his order. But then we got to a point where you had algorithms which would be programmed to recognize words and could execute quicker than a human could. And he had to adapt. And he ended up, while still trading around events and all of that, but had to adapt where that initial move, he might have done just the opposite. If it was like an initial quick move, he might have actually then gone the opposite direction because it was overdone, which was almost, like say the opposite thing he was doing in the beginning. So he had to adapt what he was doing. He was still using events. He was still using his interpretation, but he had to change the way he was doing it because of the reality of computers now doing it faster than human could. Another example is in this book is a fellow named Chris Camillo, who is using a strategy. It's not so much of a change, but it's a matter of that he's using a strategy which didn't exist or couldn't exist 10 plus years, 10, 15 years ago. And it has nothing, and he doesn't use fundamentals, he doesn't use technical, which is kind of sounds bizarre. I mean, what else is there? And the thing is, he realized that he could use social media to spot trends that will be predictive of stock market moves. And he's done that very, very effectively. So there is kind of a whole methodology that has become possible because of a change in not so much in the markets, but in the world, namely social media.
Mm-hmm. No technicals and no fundamentals.
No, doesn't use either one.
That's interesting. And I have a question related to that, because there's this unwritten thing, a concept of gut instinct, and it's bugging me lately. Have you ever witnessed a truly genius trader that is making decisions only based on gut instinct, no methodology? Or do you think that is it possible?
Yeah, it is. I can think the best example, I mean, there's a number of examples, but probably the best one is, the one who was kind of a paradigm for that, I would say, is Michael Marcus, who was actually the first chapter in the first Market Business book. And Michael, he was a psychology major, so he wasn't a quant or anything. And he wouldn't I came out of, an economics degree, and I remember that I would do all this analysis, but he would watch markets and he would know what was important. And I remember, this is the best example I can think of. Back in 73, I believe it was, 72, 73. So there was a cotton market, and one of the markets I followed as an analyst was cotton. So I did all this analysis. I came to the conclusion that in the post-World War II period, there were only about 3 or 4 markets that were free markets, because in the other markets, government subsidies basically determine the price. So I decided those were the only relevant markets, and one of those markets was similar. And so I decided that this market that we were seeing would be like that. The price was 25 cents. In that market, the price is going to 33, 34. And so I thought that my prediction was it would go up to there, and then if it got up to there, it would be, it would then get too high. And of course, there wasn't enough data to make a conclusion. That was my mistake. But I was doing the analysis. Michael didn't do any of that. And I remember I met him because he was the analyst whose job I took. He went to be a trader, and he was still in New York, so we used to get together for lunch while he was in New York. And one time we were at lunch, and we were discussing this, and I'm saying, well, I think the market's going to be topping out in the mid-30s. He said, no, it's going much higher. Anyway, that market ended up going to 99 cents. Luckily, I didn't have much money then. I couldn't lose too much, and I got stopped out very early on. But Michael, knew there were 100 different things affecting cotton, but he understood that was the first year PRC, which China was called back then. That was the first year they were a buyer of U.S. cotton and a significant buyer. And he understood that was the most important thing, and that would drive prices. So he went long and he wrote that whole move. And he just understood, so there were all these variables, but he knew which one was the important one. And he had that instinct of what was important and could react to it right away. And So he was a good example of an intuitive trader. It wasn't intuitive in a mysterious way. There was always some underlying factor that led to his intuition, whether it was like the factor I just mentioned, a particular fundamental, or it was a market behavior that reminded him of something. But he had a knack for understanding what was important in an intuitive sense.
That was really interesting, Jack, and really intriguing. And what also intrigues me is aggressive strategy in trading. And some traders tend to be really aggressive, especially in their early days of their careers. And usually it is not a good thing, but an interesting thing to hear about. And what was the most aggressive strategy among the traders that you have interviewed throughout the years?
Oh, wow. Well, there's a few traders in this book that are very aggressive. You know, they take very large positions in event situations, and they would be out the same day, and they have rigorous risk management, which is how they can take such large positions. But a couple of these traders have had returns for 10 years plus of in the order of triple-digit returns. Average 200, 300 a year. So that's an example of very aggressive. There was a trader I interviewed in hedge fund market wizards who traded in a way I don't recommend anybody trade, but it worked for him. But he would go counter to big market trends that were almost in runaway stages. So he would be the type of trader who, like, when you remember a number of years back, silver went up to like 50 cents or something. So he'd be like the type of trader who'd be selling it in the high 40s. And it's a super high risky type of strategy. And most people, 999 out of 1,000 people will blow up trading that way. But he's managed to do it. So he's an example of a very aggressive trader. So those are a couple examples.
Mm-hmm. Jack, just looking back, who would be one of the traders that you wish you had interviewed back in the days, but unfortunately cannot anymore right now?
Yeah, well, it's the trader I most regret not having interviewed, and it's not of my fault. It's not that I didn't try. Is George Soros, because Soros is probably, at least from a discretionary standpoint. I mean, you have algorithmic traders like Ed Dorpway or Jim Simons of Renaissance and that group who've had sort of maybe the best return risk type of numbers you can get. But as far as discretionary traders go, Soros may well be the best trader that we've seen in the last 100 years or ever. And so I do regret not having him. Being able to interview him. I think he had a phenomenal talent and obviously would have had great stories. And his whole life story is pretty interesting. So he's the one I regret, but I never actually spoke to Soros. I never got past people who kind of are part of his organization. And I put in requests multiple times, but I never got a positive response.
Well, that's a pity, Jack. We've already talked about the changes in the markets, but let's go back to it one more time. Do you see some noticeable trading strategy changes between the traders back in the 80s and the ones that you have interviewed for your latest book, The Unknown Market Wizards, published in 2020? What are, the most common differences?
Well, the biggest change we talked about was, we talked about some of the changes and the fact that, like the social media guy, trader I talked about, you had approaches which were impossible. So that's a big change. And I didn't have any pure quants in this book. I had one systematic trader, but not using anything that was radically different than what you could have done maybe 10 or 20 years ago. So I don't know in this book that I saw, other than people using methodologies that would have been impossible, I don't know if there were like major changes in that respect. I think you had adjustments to the fact that you have algorithms operating in the market, like I mentioned, and I have to turn off my phone. Anyway, so yeah, that's a change. But maybe the most important point to make here is that the elements which are responsible for successful trading, even though we've had tremendous changes in the structural changes to the market, the changes that are necessary, or not the changes that are necessary, but the elements that are necessary for successful trading haven't changed that much. So if you look at the first Market Wizards book, and you look, which was over 30 years ago, and you look at this Market Wizards book, and you look at my concluding chapters, on what the traits are, what the lessons are, you'll actually find a lot of overlap. That the successful traders of 30 years ago were doing a lot of the same things that successful traders now are doing. And I think that's because ultimately, no matter how much the markets change, they're ultimately driven by human emotions, which we talked about. And human emotions and behavior doesn't change. And that's why some of the basic traits that are responsible for success remain pretty much the same. Things like very, very strong respect for risk management, being very, very disciplined in your methodology. Things like that were always important and will probably always be important, regardless of what changes the markets.
Generally speaking, is there a common denominator that you noticed in almost every trader that you have interviewed for Market Wizard series?
Yeah, well, few exceptions, very few exceptions, almost none. Almost everybody, places very strong emphasis on risk management. So if there's a common denominator, that's a big one. And you have a common denominator that's actually ironic because it's a common denominator that speaks to difference. So one common denominator is, I think, everybody I interviewed sort of found the method that worked with their personality. So, of course, since their personalities are all different, that means they led to all different methodologies. But they found something that was consistent with their methodology. So, for example, in Unknown Market Wizards, there's a trader named Jason Shapiro he's kind of a guy who's always has to be on the other side. So he'll admit that if he, let's say, goes to a party and most of the people are conservative, he'll argue the liberal side. If he goes to a party and most of the people are liberal, he'll argue the conservative side. So he always wants to be on the other side. I mean, that's just his nature. He just wants to be opposite what the crowd is doing. So he developed a methodology where he's going against what he perceives to be the predominant speculative sentiment, and essentially he's doing what a lot of people advise not to do. Most people would be wise not to try this, but he's developed a methodology where it's tops and bottoms, and essentially trying to identify points where there has been speculative excess in one direction or another and going the other way. So that methodology works for him because it really fits his personality. Somebody like Chris Camillo, who developed the social media methodology. So he was the guy, he didn't particularly do well as a student. He didn't like, doing all the detailed work. He didn't like that type of focus. That's why fundamental analysis was he didn't want to do that. It just didn't appeal to him at all. And he didn't find charts, technical work for him. But as a kid, he used to do kind of like almost social media arbitrage. He would go to these garage sales and find things that were mispriced, and he like old watches or whatever, and then he would know people who would be buying that, and so he would buy the garage sales and sell that, and that was sort of how way he would go as he talked as a kid, going and seeing that his favorite soda was no longer in the machine, and finding out that it had been displaced by another soda, and then asking his brother, who was a stockbroker, how he could profit on it. This was just by observing in his real life what was going on. and his brother told him about options, and that was his first successful trade. So, but for him, evolving into a method that used social media was a perfect fit. So when you look at these traders, while they're all doing something different, the method fits who they are.
Mm-hmm. Let's now look at something that every trader experiences, and that is losses, which are inevitable, by the way, and sometimes they are really extreme. But also there are these incredible comebacks. And what is the most spectacular one that you have witnessed?
The most successful comeback?
Yeah, successful comeback, yeah.
Well, there's quite a number. If you go through all the books, you'll find a number of instances of people who blew up. Jason Shapiro, who I talked to Contrarian, initially, he ran his account up to close to $1 million 2 times and then lost everything. The second time he was lucky because he had bought a car. I forget which luxury car he bought, but he bought that car while he was winning, and he lost everything. At least he had the car left over. So, but ultimately, the reason he lost is because while he was still trying to do the same thing, he hadn't developed a good timing methodology, which he did ultimately, and he hadn't developed risk control methodology. Once those 2 things came into it, then his contrary approach worked. But initially, he blew up, big time, two times completely. Michael Marcus, who I talked about, the first half of that long chapter is all about the multiple times he lost everything. It's painful to almost to listen to it or read it, or when I was interviewing him, I remember asking him. Michael, did you ever think of giving up? I mean, I won't go through all of the stories, but they're in the book. And he said, no, I just kind of heard a voice that I could do it. And he just had this confidence that he could succeed. And ultimately, he became an enormously successful trader. He went to, at the time, Commodities Corp, which was a prop trading firm at that time. And they gave him, I think they gave him $30,000 or something. And he ultimately ran it into $80 million. And that was with them taking out profits every year. So, that's a story where he lost everything multiple. And one of the times, he not only lost all his money, but he came from a relatively lower middle class family, and he borrowed money from his mother, who didn't have much, and he lost most of her money as well. So it's really a painful story, but ultimately he became enormously successful. So it's probably as good as any, but he's not the only one.
Mm-hmm. Jack, let's get a little bit more personal right now. Personally, sure. Did you experience this kind of mental crisis, this psychological burnout as a trader, and how did you punch through it?
Yeah, specifically what mental aspect of it are you referring to?
I mean, just when you are in the crisis psychologically, you are feeling really down and all. And how did you go back to being a good trader again?
Oh, okay. So first of all, I was a horrible trader when I started, and my biggest asset, almost on there, was that I didn't have much money. I couldn't lose much. So initially, I didn't know what I was doing. I ultimately I was able to become that profitable when I started employing risk management. That was tied into my going to technical analysis, which was more compatible with risk management because you can define ahead of time, points where to put your stops. So I think that was a big element of it. That doesn't mean I didn't make more mistakes, and I did. But what I've done all through my life, and again, I've never been a full-time trader. That was the only thing I did. That was never never what I saw myself as doing. But when I was, I would trade also. Where I trade depends what else I was doing. So keep in mind that for a large part of my career, I had full-time jobs, whether it's research director or partner in hedge fund advisory firm or whatever. And on top of that, I was writing books, so I was a pretty busy guy. So I didn't have time to trade. So, so trading was always more of a sideline. But when I traded, though, what I did is I would always start with a small amount of money. I would follow my own advice. I would only risk a certain amount, and if I lost a little bit, I'd be out. And if I started making money, and I hit a point where I had a run, and then I gave back any meaningful amount of it, I usually would stop trading, close my account, and come back a few months later. So that's my way of coping always was to make sure I couldn't lose much of my starting stake. And once I was ahead, to stop trading if I started giving back anything significantly, and then come back when I felt like it. So that's been basically my coping mechanism. And it's also a way of keeping out of trouble. So essentially it's a way of making sure that I'm always playing. I'm never playing with much of my own money. So if I'm trading any consequence, it's usually because I've gotten ahead and it's with market money. When I start, I always start, with limited risk.
Jack, coming closer and closer to the end, what would be the best advice that you would give to young Jack Schwager, just starting his career as a trader? What would you say to him?
Okay, so the advice I'd give, and the thing that what do I wish I knew when I started, basically is risk management is the most important thing. It's more important than methodology. So you have to have, and it's not a complicated thing. I can give you, in less than a page, I can give you a risk management plan. In fact, in one sentence, I can give you a good deal of risk management. So it's not that it's complicated, but you need to use it. That's one of the most important things that I learned that I wish I knew, that I think any beginning trader should know, because most beginning traders think it's about, and even traders who've been around, a lot of them think it's about finding the magic methodology, that there's this great approach, entry trades, great signals. But really the most important thing, and most successful traders will tell you this, is the risk management, not so much the method itself. Of course, you have to have a method that has an edge, but without risk management, it's not just a matter of time before you lose. So that's the most important thing. And I think the other thing is you have to develop a methodology. You just can't start trading and just do it, off of instinct and intuition. People who are successful with what we think is instinct or intuition, that's really more a matter of subconscious experience, because they have a lot of experience as traders, and it comes through when they recognize situations, even if it's on a subconscious level. But for early traders who don't have that, you're not going to have the intuition to know what to do, even if you think you do. That's just you're deceiving yourself. So you have to develop a methodology, and that requires you have to read, you have to experiment, you have to find what approach is right for you. I know I've gone through many different phases. I started out just using fundamentals, and I eventually evolved to using only charts. At one time, I was purely systematic. At one point, I used charts. At one point, after that, I decided that I prefer systems because they were less emotion. And I discovered that actually systems have more emotion because you have to ride through the drawdowns, and I wasn't comfortable with that. I wanted to have more control, and I went back to discretionary technical trading. So you have to really discover what's right for you, and it can take quite a number of years, and you might go through different phases.
Jack, it was great to have you here. It was a wonderful conversation, so many insightful points, great stories, and I enjoyed it so much. So big thanks again.
Sure, I'm glad to do it. Well, good luck, and thank you.
Jack Schwager, the legendary author of Market Wizards, and our guest tonight at InvestCuffs. Best of luck, Jack, and thanks.
Sure.